You are in for a real treat today. Michael Kao and I had a fascinating conversation about everything. The dollar, liquidity cycles, MMT, QE, QT, are we in a bubble? Can the Fed pivot? Is oil going to go negative again? A little disclosure for you that's important. Towards the end, Michael and I talk about MicroStrategy, the company that pioneered putting Bitcoin on a corporate balance sheet. For over a year, Michael has been looking into the company's capital structure without any skin in the game, but very recently he did enter a minor short position in the name via a put spread. Needless to say, no opinions we discuss should be construed as investment advice. While I have you here, subscribe to the Blockworks Macro YouTube channel and leave a review of Forward Guidance on the Apple Podcast app. All right, let's get into it. I am joined by Michael Kao. Michael, welcome to Forward Guidance.
Thanks so much.
So Michael, you are a retired hedge fund manager. You're a private investor now. You've been dropping a lot of truth bombs on Twitter. Your Twitter handle is @UrbanCowboy. And just because I think some of the things you're going to say may contradict maybe let's say the priors of some of my audience. So I think it's important that they know who is saying them and what your background is, and that you're not just some guy who opened John Maynard Keynes' book and you're spouting off. Like you tell us you're legit. You've worked in currency options. You're very intimately familiar with the commodity complex as well as convertible bond arbitrage. So just tell the audience a little bit about your background, your career, as well as perhaps the unifying theme behind those three fields that to me seem very, very different.
Sure. Yeah, thank you for the intro. So I guess I started my career at Goldman Sachs in the J. Aron Currencies and Commodities Group. I traded the GSCI, the Goldman Sachs Commodity Index, when it was a very, very nascent product. This was in the early 90s. And so because it was a nascent product for us to make markets in, the way we had to really add value was to be familiar, at least have a working familiarity with all of the underlying 22 different commodities, and always have a proprietary view. Much of that view was technical trading views, but informed by macro fundamentals, right? So I guess I started my career in the world of macro. And then I decided that, because my undergraduate background was in electrical engineering, computer science, I never had a finance background. I felt that, there must be more to the world of finance than commodities. So I wanted to go back and get a formal training in finance. And so I went to business school, graduated in 97 and joined a hedge fund called Canyon Partners in Beverly Hills at the time. They've now relocated to Dallas, but Canyon was started by two former Drexel guys in the credit area, Josh Friedman and Mitch Julis. Canyon at the time was a credit-oriented fund that specialized in primarily high yield and bank loans, right? And so my background, since it was more of like a trading and options background, I wasn't quite sure where I was going to fit in. Within the first, 6 months or so, digging into the micro fundamentals of credit analysis, I honed in on the convertible asset class because I felt that it was a very misunderstood asset class wedged in between the interests of equity holders and the interests of credit holders, and also you had to understand optionality, right? So I basically created a business within a business there. I created this convertible ARB, cap structure ARB type of business that I then ran for the next 4 or 5 years. When I branched off in 2002 to start my firm, Akanthos Capital, I basically was doing what I call a sort of multi-strategy ARB. I was also focused on certain types of event ARB. So most of my professional investment career has been more in the world of micro analysis, analyzing individual companies and credits and structuring. What I would say, what set Akanthos apart back in the day was that I took a very holistic view of the capital structure and was very, very creative in piecing together different parts of the capital structure to solve a specific problem. Of that problem being, how to extract money from this capital structure in some way or another. So sometimes I would have trades that would involve, being long a convertible bond, short a high yield bond, long a convert, short the stock, long a convert, have options overlays on top of it, et cetera. And then eventually got very post 2008 when the opportunity set really changed and became less arbitrage friendly. We were much more fundamental distressed investors. And that's eventually what brought me back into the energy space. Because as you know, from the period of 2014 to basically 2020, the energy space has been in a protracted bear market. And so, the sliver of outside capital that I still manage to this day happens to be a post-reorg energy equity that we originally, when I was still running my fund, we got involved in the senior unsecured bonds of a company that went bankrupt that had crown jewel assets in the Permian Basin. And so I was part of a group of hedge funds that recapitalized this entity and formed a new company. And today, that new company is the basis of my personal largest risk asset, which is this Permian Basin-based private equity. And so, this is kind of a long-winded answer to your question of my career arc. I returned most of my LP money back in 2019. I essentially spend most of the day, though, having fun on Twitter and trading my own capital these days. But because of my outsized position in this oil private equity, I focus a lot on the macro fundamentals of oil, which in turn lead me to have other macro views with respect to the dollar and interest rates and whatnot. So all of the above are fair game, I guess. We can go macro, micro, whatever.
Mm-hmm. Yeah, so we definitely want to talk about oil. We're going to talk about convertible a bond. We're going to be talking about liquidity bubbles. We're going to be talking about crypto. You've got a lot of thoughts on all of these, and where that just going to do a little tease where that gets where those topics meet is MicroStrategy, a company that has put a lot of Bitcoin on its balance sheet, issued some convertible bonds, and there's got a lot of action there, a lot of gamma there, a lot of stuff to talk about. As well as I'll just do another little tease is that despite the fact that long-term you were very bullish on oil and have been for quite some time, obviously, as you say, you think there's a possibility that WTI crude could once again go negative. I'm not going to say any more about it. We're going to hold that, maybe people will watch it later. But now I'm going to start off, Michael, and just say, how are you seeing the macro? You said to me earlier that you think this current period reminds you more of the dot-com bubble and subsequent crash than it does the 2008 great financial crisis. Why do you say that? And then also, you have this idea of financial assets as levers that I think is also really important.
Okay, so I'm going to just take a quick step back for a second and talk about when you and I last chatted. We talked about this thread that I wrote last year called the Commodity Inflation Butterfly. And so the premise of that, I wrote that I think in March of 21, when it was still very much an out of consensus bet that the Fed would turn very hawkish. And the reason why the Fed, I forecasted that the Fed would turn hawkish was mainly because of inflation of OPEX commodities, because, having delved deeply into the macro fundamentals of oil for the last several years, I've seen the capital starvation, and it's getting the timing right is everything, and very, very difficult in this market, considering the record of poor capital reallocation in the space and just poor investor returns. But the long-term capital starvation of this sector has produced what I think is going to be a long-term structural supply deficit in oil, which is the most important OPEX commodity, right? OPEX, I differentiate between OPEX and CAPEX commodities because unlike CAPEX commodities, like for instance, copper, steel, et cetera, those tend to be fueled more by sort of growth CAPEX and home building, and they tend to be more pro-cyclical than an OPEX commodity like oil that is by far the largest OPEX commodity that has to be consumed on a daily basis. That's a factor of production in just about everything under the sun. So that was how that was the beginning of my very, very hawkish view on what the Fed would have to do. And as a result, I then wrote a number of different threads talking about the linkage between oil leading to an hawkish Fed, leading to a major headwind on risk assets, leading to a very, very strong dollar, which I called the dollar wrecking ball, which would create all sorts of problems for risk assets around the world, especially emerging market economies that are net importers of OPEX commodities. So most of that has come true. I think where I differ today is from perhaps the consensus is that I think that the Fed is going to remain hawkish for much longer than most people think. And to your question about why this current market reminds me of the dot-com bubble versus 2008, well, I would say this. In 2008, you had a lot more banking leverage, right? And so when that bubble burst, you had major credit problems. The dot-com bubble was much more of an overvaluation sort of in the equity markets, and so the thing that one of the things that reminds me most of the dot-com bubble is this bubble that we have in crypto, where in around the 1999-2000 timeframe, you had all these B2B and B2B companies like Ariba and Commerce One. Most of you guys haven't even heard of these companies. You had also the fiber optic companies like JDS Uniphase. Jim Cramer I'll always remember Jim Cramer used to call JDS Uniphase, the ticker was JDSU, just don't sell us. Famous last words. So all of these companies were bubble companies trading at crazy revenue multiples. And they floated very, very low floats. Their valuations made no sense, but they were justified by all this new paradigm talk about Metcalfe's law, S-curve adoption, network effects. Any of this sounding familiar yet? So back then, one of the biggest bubble blowers was this guy named George Gilder, who, I feel like there are 1,000 George Gilders today, especially in the crypto space, preaching, new paradigms and you're just a boomer, you don't understand how Bitcoin is valued and you don't understand the network effects. You know what? I think I've been around in the capital markets long enough that I can say that the one thing that doesn't ever change about the capital markets is greed and fear, which is why that famous book, Reminiscences of a Stock Operator, was required reading for all analysts that I hired back in the day. So there are lots and lots of anecdotal parallels for why this is like 2000 versus 2008. Here's another big differentiator. In 2000, remember, I was at Canyon from 97 to 2002, building my convert arb capital structure arb business. In around 2000, during the time when the bubble crashed, traditional sort of directional hedge fund strategies, whether they were equity based or credit based, did very poorly, as you would expect, just like now, right?
So just to explain for the audience, directional means you're betting on the price to go one way, normally up. So when the price goes down, you suffer, and they do, as opposed
exactly.
to arbitrage.
So like even when you talk about equity long short strategies, let's face it, when you've got like a 15, 20-year sort of equity bull market, most equity long short strategies are not really equity long short. They're basically closet beta. They're basically closet longs with maybe some index level hedging and maybe some hedging, but usually a very healthy net long component. So that was the case back then too, and a lot of these types of strategies got caught with their pants down. But convert arb back then did really, really well because number one, the asset class was still relatively nascent and inefficient, but more importantly, equity vol was much higher than credit vol. Let me say that again. Equity vol was much higher than credit vol. So this slide is a slide from, an investor presentation that I gave back in 2010 or 2012, just explaining what a convertible bond looks like. And so what you're looking at here is on the vertical axis, how the convert behaves relative to the horizontal axis, which is where the stock price is. So, and I basically broke it down into 4 sections. On the left, distressed, and then credit sensitive, and then balanced, and then equity sensitive. So in the rightmost 3 columns, credit sensitive, balanced, and equity, if you look at that curved line that represents the convertible price, that's there. What you're seeing is a positive gamma profile, that curvature that kind of is concave up, convex down, right? So that's positive gamma, that the convertible behaves like an option. And so when equity vol is high, you can basically hedge your convert with a short stock position and make money by monetizing the volatility. The problem is when converts go into that very leftmost region, that distressed territory where the convertible bond no longer behaves like an option, but behaves more like a distressed bond, which is much more like a short put on the assets of a company. And so in 2008, right, when I say credit vol became higher than equity vol, I meant that, in a lot of because of the credit metastasis from Lehman Brothers spreading to all sorts of credit markets, there were most convertible bonds, their underlying bond floors did not hold. And so if you were a convertible arbitrageur banking on the convert being like more of like an option and being able to arbitrage the stock against it, you're out of luck because more often than not, your bond prices dropped much more than the underlying equity prices, which, it doesn't really make sense if you think about it from a liquidation perspective, because, bonds always rank senior to the equity, right? But you had all sorts of crazy capital structure dislocations like that in 2008 that you did not really have in 2000. And so right now, in this current environment, even though you have some storied credits like MicroStrategy, for instance, and some of their bonds we can talk about are definitely in that distressed category, for the most part, you're not seeing a major sort of credit meltdown like we did in 2008. So that's what I mean by the current environment being more like the dot-com bubble versus 2008 from that one perspective. What's different though, because as Mark Twain said, history might not repeat itself, but it often rhymes. This particular cycle is complicated further by the fact that not only do we have insane bubble valuations, not just in equities, but also in crypto and real estate and all sorts of assets. But on top of that, we've got a very, very strong dollar reminiscent of that 1997-98 period. And we've also got an energy crisis and a stagflationary environment representative of the 70s. And then on top of that, we've now got the complications of geopolitical escalation with Russia-Ukraine situation possibly escalating. I think it's going to escalate into something more serious. So.
Yeah, there's so much there, Michael. I think so. I like to think it's sort of the layers of a sandwich. To say the first layer is the risk-free rate treasuries. Then in the middle, higher risk, you have credit. And then the top layer, you have equity. So you're saying that in the dot-com bubble, it was that equity vol that was going all over the place, and convertible bonds have embedded optionality in them. And if you can hedge, if you can be long volatility and hedge your deltas and everything moves around, it's just a dream, because if it moves to 110, you're going to sell there, it moves back, and you just make a lot of money that way. So that's how convertibles made money in the dot-com bubble. But you're saying then the middle of the sandwich, let's say the turkey in the middle of the sandwich in credit, that blew up in 2008, and that's why convertible bonds lost so much money. And then I'd add on top of this, Michael, so the bottom layer of the sandwich, the risk-free treasuries, and you alluded to this with the dollar, that is the volatility in risk-free treasuries is ridiculously high as measured by something like the MOVE index, which is the VIX for bonds, essentially. So even though you said credit has not, it remains, range bound, let's say, but interest rate risk is super high. And then that's,
It is.
I mean, no one who if you became an options trader in 2013, you never thought about ROE, like the interest rate, people are having to think about
That's right.
interest rates in a whole different level. If you had, I issued debt at 2%, well, if it wasn't a bond and if it was a bank loan, and if it was like SOFR plus 5%, as in the case of, let's say, MicroStrategy, you have to pay, your interest rates go up and up and up. So I just think you have sort of this house of cards where there's so many things that are lining up. But
I mean, I just want to pull on a thread that you just said. I think the way you just teased out the different components of risk is a very important. It's a very good way of looking at the markets. And so in a way, my career spent looking at the convertible asset class has forced me to have macro views along all sorts of different risk dimensions: the equity dimension, the credit dimension, the interest rate dimension, the vol dimension, right? So you have to pay attention to all of those. And so, I can even give you some war stories about in 2008, how,
Please.
By having that holistic view, it really helped protect me in certain situations, right? So I'll give you just a quick example of how I was thinking about the interest rate risk. So as you alluded to, the row risk of converts is the underlying interest rate risk. And so for the longest time, it's kind of a joke amongst us convert arbs that the row hedge never ever seemed to work, because every single time there was a major credit crisis or equity crisis, you would have this safe haven bid in bonds, right? So whatever money you might have made being short equity against your convert, you would give it up on your bond hedge because bonds would spike in a safe haven. So I was recently just having a conversation with another fellow ex-convert arb. We're saying, holy shit, this current environment right now, I'm actually kind of missing my days as a convert arb right now, because like for the first time, the fucking row hedge works. Sorry, pardon my French, but I mean, it's awesome that there's, credits are relatively holding up, equity vols off the charts, and my row hedge works. But like in the 2008 timeframe, I had to resort to creative ways to hedge the row. So for instance, I had a big convert book at the time, right? So we used leverage obviously as a convert arb, and so I had a multi-billion-dollar notional long to hedge in converts. And so I basically had to, diversify along the curve, but also try not to be caught in being short certain on-the-run treasuries that would basically be the focus of safe haven buying if there was like a major sell-off. So in 2008, I found a really, really interesting way to kind of protect myself. This is before the Fannie Mae conservatorship. Fannie Mae was a super levered capital structure, right? If memory serves, it was like something like 900. There was something like 900 billion of senior notes. Then there was a small sliver of senior sub. I think it was something like 15 billion or something like that. And then there was a sliver of preferred that was 35 billion. The senior notes, the 900 billion or so, because they were kind of implicit Fannie Mae, agency credit, they were trading at something like LIBOR plus 20.
20 basis points. 20 basis points.
Yes.
Yeah,
yes. Okay. Beneath that sliver of the 900 billion, you had basically 15 billion of senior sub that was trading at maybe LIBOR plus 35. So an additional 15 basis points to be on that lower rung, right? So I thought, well, shit, these are pretty liquid agency bonds. And for an extra 35 basis points, I can basically be short a super levered agency credit at LIBOR plus 35. And if the shit really hit the fan, I just might get lucky. And by the way, because the credit spread is so tight, it would basically, I replaced all of my treasury hedges with this massive short in Fannie Mae sub paper as my row hedge for my convert portfolio. As luck would have it, Murphy's Law always strikes, right? So I also had on this capital structure ARB where I was long. There was a bunch of dislocation. This is already like in the summer of 2008. There were cracks appearing in the agencies. So there were huge capital structure dislocations between different tranches of preferreds in Fannie Mae. So I was short and on the run straight preferred at say 90 cents on the dollar. And then I was long the convertible preferred, which was a pari passu preferred, at maybe 70 cents on a dollar. So the spread was pretty big, right? Which is why I had that trade. The week after Lehman Brothers went bankrupt, the week before Lehman Brothers went bankrupt, if you remember, Hank Paulson put Fannie Mae into conservatorship. And so what he did was something no one expected. He drew an arbitrary line between the prefs and that next rung, which is that 15 billion of sub debt, and said everything above the line gets a government guarantee. So I actually lost money. It went from LIBOR plus 35 to LIBOR plus 0, right? It became government credit. But then everything below the line, right? Everything below the line basically collapsed down to like 2 cents on the dollar. So even though I lost money on my row hedge by a little bit, I made a bunch on my capital structure arb because that 20 point basis between prefs collapsed down to something like 2 cents. And that's a whole other story, but that's how I eventually got involved in this whole GSE pref trade. But it was through this capital structure arb that I had on, and that big row hedge.
Nice. Michael, because you mentioned Hank Paulson, obviously the Fed and the Treasury, huge bailout of Wall Street in 2008. Likewise, Fed, huge bailout of the entire economy in 2020. Can you talk about how it was perhaps a fear of insolvency, a fear of a freezing, a collapse of the credit markets that motivated those interventions by the Federal Reserve and not a collapse in equity prices, for example? So, some people say, hey, Michael, my crypto went from $9 to 90 cents, but the Federal Reserve is going to save my crypto. Or, hey, I invested in this SPAC. It went from $10 to $80. I bought it at 80. Now it's at 4. The Federal Reserve is going to save me. Why might those people be wrong?
So I'll say that, look, the QE, at least the QE that we all know and love, was basically invented during that crisis, right? The massive flooding and outright asset purchases, like represented by TARP, were absolutely necessary because that was really the only, quote, legit use of QE I can think of. Because if you lived through that crisis as I did, you knew that even good banks were basically were down to maybe 1 to 2 weeks of liquidity, because in banks, unlike most businesses, the what I call perception to reality risk is very, very real, where you might have a couple of bad apples like Lehman that fail, but then what happens is it creates a whole crisis of confidence that leads people to effectively pull their deposits, right? And so when you've got banks that don't have a ton of customer deposits start experiencing the proverbial run on the bank that you saw back in Mary Poppins, where the two kids are demanding their coins back from the bank. That's basically what happens, and perception becomes reality. And the banking system, the entire banking system, was at risk of systemic collapse. And that's basically when they took out the big guns and arrested this whole crisis of confidence by basically just massively expanding the Fed balance sheet and saving the system. What I wanted to highlight was that since that application of QE, the Fed has totally gotten addicted to QE and essentially prompted the invention of Bitcoin, right? As a way of hedging against forever debasing of the US dollar. And so it shouldn't surprise you that Satoshi's white paper came around at exactly that time, 2008. And it shouldn't surprise you that since 2008 till now, there has been this deeply embedded feeling that whenever there is any sort of crisis, no matter how, quote, small the crisis is, if it's just like a pricking of equity or crypto bubbles, the Fed is always going to come back. Well, here's where, again, I think I have an out of consensus view right now. I think the assumption that the Fed put is there or nearby is really, really subject to rug pull, because what enabled this massive balance sheet expansion from 2008 till now was just an unprecedented period of low to almost non-existent inflation. We just had no inflation. And so every financial ill was curable by this panacea of flooding the markets, including the recent COVID experience. And you see that step change in this chart. This chart, I think, should scare everybody, because this is such a massive mountain of the expansion of the balance sheet that it just makes me kind of laugh that we are 2 days into the official start of QT, and I'm already hearing people saying, given the equity returns this year, the Fed really needs to take a pause here. What the heck are you talking about? I mean, I think it works in an era of sub 2% inflation. But if you think, as I do, that this structural commodity inflation, which has been years in the making and exacerbated by crazy ESG policies and now super exacerbated by this war, these supply-driven structural deficits in OPEX commodities are not going away anytime soon. I think they could be with us the entire decade, as a matter of fact. And so if that is the case, QE cannot fix this ill. The other thing I'll say is that the expansion of the balance sheet is a combination of outright QE plus MMT, right? So if you think about what QT has to do, QT has to try to undo both QE and MMT. I recently listened to a podcast about MMT, and with MMT, you would think that usually the way to drain, usually the fiscal drain would be some measure of high taxes or whatnot, right? But we didn't have that this time around due to just political gridlock, and so it's basically left on the Federal Reserve to use the only blunt tool they have, which is monetary policy, to essentially create enough demand destruction to counteract both QE and MMT. And the level of demand destruction necessary to offset this long-term structural supply deficit we have, I think foretells much, much lower asset prices, a much lower level of where that Fed put is ultimately struck. I'm not saying the Fed put is gone forever. I think it comes back at a certain point, but I think for anybody thinking that it's around the corner and the Fed might pause in September and that might be it and we're off to the races again, I think that assumption is subject to major rug pull.
I completely agree with you, Michael. So modern monetary theory, MMT, is a framework that I'm going to paraphrase and oversimplify, but essentially that government deficits and debt by themselves are not a sign of malaise. What's bad is inflation. So if from 2009 to 2018, 2019, as you say, the US government was still running significant fiscal deficits, but we didn't have inflation. So the folks who were saying we need to either raise taxes or cut spending or do both to reduce the deficit, MMT would say, well, not so fast. We don't have inflation. Well, now we do have inflation. And, I do agree with the view that quantitative easing by itself is not very inflationary, or perhaps not inflationary at all, because it's just like printing as Joseph Wang, former central banker, says, it's like quantitative easing is like printing a $100 bill. The Federal Reserve prints a $100 bill, right, and then it buys $100 worth of treasuries, and it's just a swap of $100 bills. However, if you have the Treasury issuing debt at the same time, and also you have the government making loans that are forgivable, I mean, that is just, we've had a money printing bonanza over the past 2 years. To me, it's undeniable, not by the commercial banks, but by the government, and the Federal Reserve definitely helped play that. And yes, I mean, the US is not used to having fiscal constraint for 30, 40, 50 years, because we've been the global reserve currency. So all of this tightening has to come from the monetary policy. So Michael, I think you are dead on the money. I think the Federal Reserve, I think there's nothing stopping them. I mean, maybe, high yield, triple B credit spreads to 9%. All right, maybe that's a different story. But S&P 500 down 30%. I mean, it's only down 15% now, and people are already saying the pivot is going to happen.
No, I think that is exactly the type of moral hazard that has been ingrained into the system over the last 15 plus years that needs to be wrung out of the system. The assumption that the Fed put is always there around the corner. We're in a different regime. It's a different regime that none of us, frankly, have lived through. I mean, I've technically lived through it because I'm 51, but I was a kid. Star Wars just came out, so I think this is a brand new regime, and it's got some scary implications. It's something unlike pretty much all of us that are active market practitioners, something unlike we've ever seen before. Really, it's this confluence of the biggest asset bubble, biggest everything bubble of all time meets this structural inflation that we haven't seen since the 70s, where we've got the makings of an energy crisis that's as bad as the 1973 embargo of oil. The difference this time being that maybe the oil spike isn't as bad as 1973 in percentage terms, but this time the energy crisis involves not just oil, but all energy, natural gas, coal, uranium, everything. And this is driving also this dollar wrecking ball, which ultimately the dollar wrecking ball is going to be self-correcting, because I feel like, it's going to really hurt China, for instance. I keep honing in on China because I think that China in particular already had major issues of its own, given Evergrande last year and then these perennial COVID lockdowns. And so their monetary policy is going in the exact opposite direction as ours. And they've been artificially pegging the yuan at an artificially strong rate. And so as you've seen in recent weeks, that yuan has been weakening. I personally think that the yuan is going to go north of 7 before all is said and done. But ultimately, that will self-correct because it's going to produce a recession and some demand destruction in oil. Oil, I think you asked me earlier, oil is a little bit complicated. I believe in this longer-term structural thesis, but in the shorter term, I do see some headwinds with oil, mainly because of part of the dollar wrecking ball, partly because of China, but also partly because I don't really see Russian oil flows getting materially disrupted, as the market seems to imply, unless we actually escalate to actual blockades of seaborne routes. So part of this recent oil spike, I feel, is more sentiment driven than real fundamental. So that's just my short term view. But that said, since I have a ton of exposure to that, I'm not complaining either.
Right. Yeah. You know a lot about the energy market, not just looking at a chart, but the real fundamentals on the ground of the ships, of the terminals, of the pipelines. Explain why. So to me, perhaps I'm Joe Sixpack when it comes to like financial news. I read an article about the U.S. and Western Europe stepping away from Russia. There must be a shortage of oil and natural gas. The price of natural gas goes up. It makes sense to me. Why is that narrative wrong? And maybe the price is creating the narrative rather than the narrative creating the price. And can you also go into the specifics of just how Russian oil and natural gas continues to flow out of the country? I mean, are they doing this? Are they switching via one ship to another? Are they selling to China, India? Like, what's going on?
Yeah, I mean, look, the simple narrative would be that, oh well, whatever we sanction or embargo from Russia will just easily get routed over to China and India. And you're definitely seeing some of that. You're seeing, for instance, Indian refiners really, really picking up the slack and getting more crudes, et cetera. You're definitely seeing more cargoes, bound to not just China but the rest of Southeast Asia. But that's part of the reason why I'm a little bit leery to believe the current price spike in oil, because I'm not really seeing any real Russian disruptions. Now, if we actually see a real escalation of blockades, or whatever you want to call them, right? Because like blockades, everybody pretty much agrees, is almost a reason for outright war, right? Forgetting the fact that Russia is already blockading the Black Sea, and they did this back in 2018 as well. But as of right now, NATO and the EU are doing different types of financial sanctions and embargoes, but none of that is really disrupting Russian flows. if we actually do blockade seaborne routes, to me, why am I harping on seaborne routes? Because if you think about Russia oil flows to China, the only landborne routes are via the ESPO pipeline, the East Siberia pipeline. And that's currently flowing at around 1 million barrels per day. It maxes out at 1.6 million barrels per day. The rest of, Russia's, call it 5 million barrels per day of exports are seaborne. So the majority are seaborne. So if we actually have a material disruption of seaborne routes of more than, say, 2 million barrels per day, that's really going to challenge all of the spare capacity within the GCC countries. I'm also more conservative than a lot of oil folks out there. I tend to gravitate towards the more conservative numbers that Capital One puts out on global spare capacity. And if you count the GCC countries as well as outside the GCC countries, Capital One would say that global spare is closer to 4 to 5 million, not the 1 to 2 million that some people tout.
What's the current global deficit, roughly?
I would argue that we're not in deficit, because I would argue that right now, I'm gonna quote Lakshmi at Capital One. She loves saying that spare capacity is not a consumer call option. It's not meant to basically bail out stupid energy policies of the West. It's really meant for true geopolitical disruption. For instance, when Abqaiq got bombed by the Houthis, right? You literally saw Saudi Arabia not skip a beat. There was never any force majeure declared on any Saudi Arabia barrels, despite a disruption of close to 5 million barrels per day of capacity, right? That's what true spare capacity is meant for. And so I think. Sorry,
I was just going to say it's a very deep out of the money hedge. It's not gas is now $4 a gallon. Let's save the consumer. No, it's like a deep hedge.
Right. It's a true outage hedge. So, for instance, if the Russia situation really does escalate and 2.5 to 3 million barrels per day gets taken offline, that's where I see the GCC countries, especially, tapping into their spare and trying to make up for that loss.
So what about the natural gas, which Europe is, especially Germany, much more dependent on Russia for? Do you think, a lot of people saying, Europe can ban Russian natural gas. Do you actually think that it's Russia who holds the cards, and if anything, they're going to not stop sending gas to Europe?
Yeah, I don't know the European natural gas fundamentals as well, so I can't really speak to the specifics there. But for sure, the gas dependency is far greater than the oil dependency, and I think this is why I feel like nothing short of a true escalation is going to matter, because if the EU is having this much trouble in the summer to get any sort of solidarity on oil sanctions, can you imagine what's going to happen when it's November and this war is still raging and we're about to have winter come, and you think that the EU is going to have any solidarity in terms of sanctioning gas? I doubt it. I doubt it. So yeah, it's that. I think that'll be pretty interesting. So my base case is that we're not going to see that the escalation lead to actual, going back to oil now, lead to actual significant losses of Russian supply. And so if that's the case, I feel like we might be a little bit overdone in oil in the short term.
Mm-hmm. And Michael, earlier yesterday, you painted a picture for me that I would say is a black swan event, where the U.S. would reimpose an export ban, and that could drive WTI, American oil, Western Texas Intermediate, crude oil back down below zero to negative numbers, and then Brent could spike way higher. Tell us why you see that scenario, and can you also just explain what is an export ban and why would the pressures on the U.S. administration be to enact that policy?
Well, so back in November, I wrote this thread called the administration's Kobayashi Maru, and Kobayashi Maru reflects it. It harks back to this old Star Trek episode. Even though I'm more of a Star Wars fan, I quoted Star Trek here. Anyways, Kobayashi Maru was this unwinnable scenario that Captain Kirk was facing in this simulation. And so I basically, in this thread, I painted, 4 no-win options that the administration was facing with respect to how to deal with high oil prices. And the 4th option, which is the biggest black swan of all, that I will sometimes hedge, I call it my administrative stupidity hedge. It's this ban on exports because, see, here's the thing. An export ban, there are some geopolitics experts out there like Peter Zeihan, who I respect very much for their geopolitical views. But Peter thinks, for instance, that an export ban is going to imminent. And because we are energy self-sufficient, that we could be a sort of bastion of self-sufficiency and basically cut off our flows from the rest of the world, right? Because after all, we had an export ban in place for 40 years, until from 1975 to 2015, and then it got relaxed. Well,
sorry, Michael, just to give a little history, right? The history is huge energy crisis in the 70s. The idea is let's ban U.S. oil from leaving the country. And then why did Obama repeal that in 2015?
Well, yeah. So from 1975 to 2015, this export ban really didn't make a difference to us because, let's face it, this was pre-shale revolution, and we really didn't have any real net exports to ban. So it was kind of no skin off our back to make this big political statement, right? But the reason why the Obama administration lifted it is because the shale revolution was just starting its ascent. And in a way, it was the relaxation of the export ban that really created the accelerant to the production, the shale production. So our refinery network, which is mostly based in the Gulf Coast, which is called PAD 3, probably where 80% of our refining capacity resides, is tooled to refine heavier grades than what shale oil produces, which are light grades. And so if we now, and this is also very interesting, pre-lifting of the export ban, we were importing roughly the same amount of oil from the Middle East as we're importing now, even years after the export ban got lifted. Why do you think that is? Again, it has to do with what our refiners need. We need heavy crudes from the Middle East. We would have been able to get a bunch of these heavy crudes from Canada had some of those pipelines been green lighted, but they weren't. So we need to import grades from the Middle East, and so in return, we are net exporting. What you see as our exports are mainly our light grades that the shale industry produces. If there was an export ban, this is exactly what would happen. The refiners in the Gulf Coast, which are already running at capacity, would basically have to turn back the excess oil because they can't ship the rest out. So oil backs up all the way back to Cushing. Cushing fills to tank tops. You get a repeat of what we saw during COVID, where WTI collapses, potentially goes to negative as Cushing goes to tank tops. But then what happens is that the only part of our refining capacity that can actually utilize our light grades are in the Northeast, PAD 1. But the problem is there are no pipelines between Pad 3 and Pad 1, so they can't really get our shale crudes, even if the Jones Act restrictions, which are restrictions on using domestic shippers to ship oil from the Gulf Coast all the way up to the East Coast, even if that got relaxed, the point is that the Pad 1 refining capacity is such a small sliver of overall refining capacity that it wouldn't matter. So they would have to import gasoline and Brent, both of which would be spiking because the rest of the world would not be able to source our light grades. And so it would just create just this massive, massive shit show. The right way, the only way that we can truly be, quote, energy independent is to essentially offer subsidies to and forced subsidies in a way, force the refiners to spend these subsidies on retooling all of their refiners now to be able to handle basically our light grades. But that's a multi-tens of billions, multi-year type of retooling project. But once that is done, then we can be that bastion of self-sufficiency where we can basically say, hey, you know what? We don't care if Russian oil gets, disrupted because we can produce all we need at home. But right now, that's just not the case. And an export ban would have a massive, massive backfiring effect on the consumer. And where I live in California, we're screwed anyways, because California, we have basically no pipelines from Texas. And so we're importing. The reason why I'm paying close to $7 a gallon already versus the rest of the country is because we're sourcing pretty much all of our crudes from the Middle East, which is totally ridiculous.
That's mind blowing, Michael. So it's been give me some rope here. So heavy and light. So when you have heavy is like what they use to make asphalt, and then then there's gasoline, and then there's jet fuel. Is jet fuel light and asphalt heavy, or do I have it backwards?
I believe that's the case. Yeah, I'm not an expert on the various grades. I remember, I had this complicated chart that basically shows the different API gravities for different functions, but it's a whole complicated supply chain, the entire petroleum complex. But what you're highlighting though is a point I made earlier about how, look, petroleum is a factor of production in just so many things, from all the various grades of fuels, but also to petrochemicals too, right? That's also part of that's also a huge use of petroleum, which is why oil has been the primary commodity that I've focused on the last 8 years.
Yeah. So just to get this straight, the U.S. produces a lot of oil, but that is light oil, and the refineries in Texas, mostly Pad 1, Pad 3, mostly produce
Pad 3.
Pad 3. They refine heavy oil, which they have to import from the rest of the world
and mix with our light grades.
Oh, okay.
Yeah.
And mix.
They need to blend it. Yeah. So it's not that we don't use any of our light grades. We use certainly a lot of it, right? But we're tapped out in terms of what we can use. So that's why, remember I said earlier why, I can't remember the exact numbers, but I read this paper that was commissioned by the Department of Energy, I think around 2016 or 2017, shortly after the export ban got lifted. And I was very, very surprised to see that pre-lifting of the ban and post-lifting of the ban, our imports were about the same. So that just tells you that our refining capacity just has not been retooled in decades, and that's really the key to solving the U.S. energy independence issue.
Michael, let's now move on to a subject that's I know very important to you, which is bubbles and the power of bubbles to be capacitors for inflation. You said earlier that this bubble now, which you see not only in speculative growth names, but also in crypto, was bigger than the dot-com bubble. Just elaborate on that a little bit, and then let's get into crypto, because I know you've got some thoughts on whether it's possible to even value it at all.
Yeah, there's so much to unpack here. Last May I wrote this. I'm a big fan of using sort of mental models from other disciplines like physics and sciences to think about things in financial terms. And maybe that's a holdover from my engineering days, but I think of bubble assets as capacitors. And I guess the non-electrical engineering analog to a capacitor would be like a water tower, right? So it's kind of like a temporary store of excess liquidity. And when there is a need for that excess liquidity to be drained, these capacitors basically get drained, right? So if you think about my capacitor diagram, my circuit diagram, the Fed has been the battery that has been charging this circuit, which is the economy, right? And so, but there's been so much current coming from the Fed that these capacitors have stored up extra charge. And so in 2000, the bubble was primarily in tech stocks, dot-com stocks. 2008, the bubble was primarily in housing. Here now, if you go back, if you look at that chart that you had earlier and you see that step function of where the federal balance sheet has gone since '08 to now, I mean, you think about, the equity bubble has inflated and filled up. The housing bubble has inflated and filled up. Oh, but wait, we've got this new asset class called crypto, which until recently had filled up to like a $2 trillion valuation. So you've got bubbles all around. And, the good thing about crypto, I will say, though, is that if it weren't for that $2 trillion inflation in this third asset class, who knows where housing and equities would be now, right? So it did take some of that excess liquidity elsewhere. But now that the liquidity has to be withdrawn because of inflation, you're going to, and because the monetary tool is a blunt one, it's basically going to drain liquidity from all of the bubbles together. There are two threads that I wrote about crypto valuation. There was one that was called Playing Jenga with the Ouroboros. And that one I wrote in February of this year. And I basically said, okay, I kind of broke up crypto between sort of the store of value type of crypto, which is, Bitcoin and say NFTs, because the two are very similar. You can't really fundamentally value them. They are sort of eye in the beholder types of assets where truly the value is in the eye of the beholder and the greater fool, right? And then there's the category 2 of crypto, which would include, for instance, Ethereum and just all the DeFi tokens out there. I basically say that, look, this category 1, you really cannot value fundamentally. And the problem I have with Bitcoin is that the narrative keeps changing because, some people will argue that it's a store of value and, it's like digital gold. And okay, so then I say, okay, so then you agree that it's a greater fool trade. Oh, no, it's not a greater fool. That is a negative connotation. But there's value in the network. Again, Metcalfe's law, the adoption, the network. Okay, how does the value of the network translate into cash flows to the investor? Because when I hark back to the bubble of 2000, right, even though the underlying equity bubble was such that these B2B stocks had stupid inputs going into the model, you at least had a valuation framework, right? What you're taught like day one in business school is how to value a financial asset, be it a capital project, an equity, a piece of real cash flowing real estate, whatever it is, you can boil it down to a discounted cash flow analysis, which discounts cash flows ultimately. And even though a lot of growth stocks never ever pay dividends, the valuation framework assumes that eventually, even an Amazon.com eventually is going to mature to the point where it's going to start dividending cash flows back to the investor. The framework exists. No such framework exists for crypto. Now, the pushback I've gotten is that there are some people who have actually tried to do a DCF of Ethereum and say, hey, look, you can model it out. You've got these gas fees that are revenues, and based on the gas fees, there's discounted cash flows back to token holders. Really? What are the revenues based on? What are the gas fees based on? Oh, the gas fees are actually based upon a starting value to the tokens themselves that you're trying to value. It's as if you're trying to value company XYZ, whose business is basically issuing shares of XYZ. So the problem I have is there's this built-in recursion into these valuation frameworks for these category 2 assets where you're arguing some sort of network of value accrual to the network effect. So I have a problem with that too. And so you go back to, okay, let's just go back to the simple narrative of Bitcoin. It's a store of value, and it is just a store of excess liquidity and a hedge against, forever debasement of the US dollar. Okay, I can kind of buy that, but then here's the problem with it. One of the big use cases of, or one of the big, arguments for the Bitcoin maxis is that, because we are fundamentally limited to a 21 million coin supply, and already 19 million of the 21 have been minted, you're going to have this supply inelasticity, right? And that, eventually you could see, each coin going to like $1 million, et cetera, et cetera. Well, something I say, there's another thread that I wrote most recently called The Beginning of the End of the Liquidity Lottery. I wrote this May 16th, so it's probably one of my more recent threads, and where I talk about, okay, well, let's play this out to the limit. The sword, I like to say that the sword of inelastic supply cuts both ways. If you look at that thread, I basically go into like basic econ 101 and look at what a perfectly inelastic supply curve looks like. When you've got a perfectly inelastic supply curve, it's vertical, right? And so what happens is that if demand keeps going higher, then you have these parabolic increases in price. But if demand goes down, you've got a parabolic decrease in price. So the extreme of that would be, well, gee, the NFT of that tweet that sold for $2.8 million, that's basically a perfectly inelastic supply. That's basically what Bitcoin would look like if the last 21st millionth coin got mined and you're sitting at a nominal value of X. Let's just humor the Bitcoin maxis and say it's trading at $1 million a coin. Well, if you've got perfectly inelastic supply at that point, how much of that can you actually monetize and actually sell, and who's going to buy it, right? So basically you saw that in that NFT situation, when the marginal buyer was gone and you have perfectly inelastic supply, the price went from 2.8 million to zero, right? There's no marginal buyer for it. And that's the problem, right? So I think that, look, the supply inelasticity argument might be bullish price, but it's bearish adoption too, because you're not going to have Bitcoin being adopted as some global reserve currency if there's a artificially limited supply. But then if there's supply elasticity, right, like the US dollar, for instance, it might be ultimately bearish on price, but it's bullish on adoption. So it's, which is it? And the fundamental problem I have with the Bitcoin argument is that the narrative just keeps changing. It just keeps changing to kind of suit whatever story justifies like a higher price for it. And so ultimately, I'm left with just thinking, you know what? I think this time is no different. This is yet another B2B example of like an artificially scarce, artificially engineered supply scarcity that's very, very reminiscent of the dot-com bubble. And if I'm right that structural OPEX inflation is here to stay for a long time, you're going to see continued draining of this inflation capacitor along with other inflation capacitors. I think another big shoe to drop, frankly, is just housing. Well, real estate generally, but housing. And to your point earlier, Jack, about like, thinking about different components, risk-free rates, credit spreads, equity market risk premiums, I think of the world that way too. I mean, the equity market risk premium is what real estate people call cap rates. Credit spreads is basically the same thing, except for, credit markets. So all of those various estimates of risk premiums are built upon the risk-free rate. And I think the risk-free rate all along the curve is going up. One thing we didn't even talk about is, it's not the quantitative tightening, just like quantitative easing was the creative solution to what happened when we reached the zero bound for the Fed funds rate. How else could we stimulate the economy? Well, let's suppress yields all along the curve. Well, now you could argue that the Fed funds rate ceiling, for us to pull a Paul Volcker type move and jack the Fed funds rates north of the inflation rate, well, that's just not going to work given the various funding stresses that it would cause, not just for corporates, but for our own government, right? Well, why can't QT involve an artificial steepening, what I call a bearish steepening of the yield curve? And maybe that comes from, issuing a 50-year bond or pushing treasury auctions out along the curve. I mean, frankly, I've thought for decades now that if the ducks are quacking at the long end and willing to basically pay 3% for 30-year sovereign risk, we should be terming out all of our debt at the long end. We should do it. A couple of weeks ago, I was talking to Bill Fleckenstein and Grant Williams on their podcast, and we were talking about, what would be an interesting way of trying to institute like a controlled demolition of risk assets, right? The proverbial soft landing. I don't know that there's a good answer to that, but I feel like maybe the best shot at it is to try to do a bearish steepening, maybe limit what you do at the front end, maybe stop at 2.5%, 3% tops, but try to steepen that back end so that you have, a higher risk-free rate going out to the 30-year that has the effect of muting asset bubbles, for instance, like in real estate, without necessarily creating major funding stresses at the short end.
Yeah, the vast majority of debt is for corporates as well as governments, as you say, is at the shorter end of the yield curve. So you're saying there could be a cap. We can't go beyond 3% because the system will truly break, not just a SPAC goes down 90%, but truly break. So therefore, the monetary tightening has to be on the long end of the curve, and the Federal Reserve is going to sell a lot of coupon securities. The Treasury is going to issue a greater proportion of coupon securities, longer duration securities, rather than issuing short-term bills. I actually think the Treasury has already made some noises indicating that it plans to do exactly that. So you have the Federal Reserve selling trillions of treasuries. You have the Treasury issuing tons of longer dated. I think the only argument that would be counter that, Michael, is just the economy is going to slow so much that there's going to be a huge risk for long-term paper. So this is a really interesting idea, but I promised my fellow podcast host Afonso Pecatiello, that I wouldn't talk about this anymore with you because you are going to be presenting that idea on the macro trading floor later on in June. So if people want to hear about that, they're going to have to wait a few weeks. Michael, I'll just quickly say on Bitcoin and crypto valuations that I think this idea actually occurred to me as you were speaking, that you can't value crypto in fiat terms. Crypto begets crypto in the same way that a fiat project begets fiat. So you yes, you can sort of create synthetic fiat cash flows on crypto by selling a covered call or doing a selling put spread or whatever. But a yield farming token will give you that token. Ethereum will burn Ethereum for you, being a sort of a net buyback for you. But for it to give you fiat, that kind of defeats the whole point of crypto.
Well, I mean that's interesting, but the issue I have with that is that if we live in it's great if we live in the Ayn Randian utopia called Galt's Gulch, where we have everything denominated in a libertarian currency, but we don't. We live in the world of fiat, and so I think that look, the use case to the people living in third world countries that are truly unbanked, there is a real legitimate use case there because they probably have more trust in crypto than their own government's currency. But for the bulk of the developed world, especially for those of us here, where you're not going to buy a pizza with a Bitcoin. Maybe somebody did once upon a time and they're regretting it. But ultimately, what Bitcoin and the rest of crypto represent are ways of making more fiat. I mean, let's just call a spade a spade. They're ways of making more fiat. And if everybody, if you're truly thinking that Bitcoin is somehow going to supplant the US dollar as a global reserve currency, I think you might be waiting for a long time for that. It doesn't meet any of the criteria, not even close. Not even close.
I would say I'm a long-term bull on crypto, but in terms of the shorter-term headwinds for crypto, I definitely think you make a lot of good points. My final thing I'll just agree with you on is that I think you're absolutely right that there is a trade-off between the tokenomics and the economics, meaning that the protocols and practices and technology that would incline a digital asset to increase in price are sort of contrary to it actually being useful to its holders. For example, Uniswap is an incredibly useful protocol. I've never used it myself, but I've read a lot about it. But the tokenomics are not that great. If you look, it's down quite a lot. There are some other protocols, perhaps in the number 1, number 2 slot, that are a little bit more. They're a little trickier to use, but their tokenomics are phenomenal. I mean, they have insane returns. So I think that is definitely a headwind. But Michael, let's set aside whether we think Bitcoin is going to zero, whether it's going to $1 million. I want to really bring everything together. Tell me about a certain company called MicroStrategy that bought what was among the first company to do it in a big way, put Bitcoin on its balance sheet. It funded that in a very interesting, very clever way, I would say, via convertible debts, convertible bonds, which you are intimately familiar with, and you have been very outspoken in your views on this. Just walk us through what you're seeing there.
Okay, so I first wrote about this. Oh gosh, many months ago, maybe a year ago, when Michael Saylor first issued his 2 converts. Yeah, he wrote here. I'll figure it out, but my first mention of this was back in February of 21, and he had just issued his second convertible bond. So the first convertible bond was a 0.75% coupon due in 2025. The second convert he issued was just a heroic issuance on his part, a 0 coupon due in 2027. That was $1.05 billion. Sorry, 1.05 billion. The first one was 650 million. Then once he's exhausted his convertible issuance capacity, he issued a senior secured 6 1/8 coupon due in June of 28 to the tune of $500 million. And most recently, in March, he issued a private senior secured piece of debt that even primes that senior secured note. This one had Silvergate as the private lender. This one was priced at SOFR plus 3.7%, and this one is due in 2025. So all in, he's got about $2.4 billion of debt. I wrote a thread in April of 21 called MSTR, a real options analysis, where I go through how to look at a company's capital structure from an options standpoint. And here I want to differentiate real options from financial options. A financial option is like a call and a put on an equity, as you and I normally think of options, right? That's a financial option or an equity option. A real option is when you think of a company's capital structure, and you think about the accounting identity, assets minus liabilities equal equity. When you think of that accounting identity, here's how to think of it in option terms. The equity is basically a call option on the company's assets, and the strike price of that option is struck at the amount of debt there is. So if the company's assets exceed the amount of debt, right, then you have, you as the equity holder have a call option on that, right? Now, conversely, if you own a bond that company has issued, you are effectively short a put on the company's assets. And the put strike is the par amount of total amount of debt. So if you think about it, right, a put call option looks like this, put option looks like that, right? And so when you look at this, so now let's go back into the world of financial options and think about this chart that you have on the screen. The reason why when a bond starts going into its distressed territory, it starts pointing down is exactly reflective of that short put analogy I just described to you, right? When a company gets so distressed that the bond's value starts acting like a short put on the company's assets, you have that negative gamma zone of that distressed area. Okay, so with that out of the way, let's think about what Michael Saylor has done to his capital structure. Before he did any of this, by any Bitcoin, I think MicroStrategy was trading at around $1 billion market cap. I've never delved that deeply into the fundamentals of his software business, so I can't speak to it with a lot of detail. But it was, from what I understand, it's a fairly slow and steady, low growth type of business. It was valued around $1 billion, trading at about $150 a share.
Michael, it was a profitable business, a slow growing, profitable business. It was not a money loser.
Business.
Yes,
correct. But then he gets the Bitcoin bug, and he decides that, you know what, he wants to swap all of his treasury cash, and not only that, but he wants to lever up and buy Bitcoin with it. And so now, 2.4 billion of debt issuance later, what he's effectively done is he swapped a zero vol asset, which is cash, right, to a 100 vol asset, which is Bitcoin, and he's amplified it even more by levering to the hilt, to the point of 2.4 billion. And now, before this latest tranche of 700 million of debt issuance, the secured debt issuance that's coupon bearing, he was actually in decent shape. And I wrote at the time, look, he's issued 1.7 billion of convertible debt. The coupons are low. The first maturity isn't until December of 2025. And I basically said, look, he's got a lot of time on his hands. And since he's got super majority voting control, no one can force his hand. And, the only real risk is just his business deteriorating, whatever. Well, I think he's materially up the ante by issuing $700 million of coupon bearing debt, because the coupon bearing debt now, by my calculation, has estimated debt service of close to $45 million, which is about more than half of his EBITDA. That's before CapEx. If you assume that his CapEx is necessary for the maintenance of his business, he's left with a razor thin free cash flow margin on his business. And remember, we talked about this business to reality risk that the banking system had. Now, granted, his software business doesn't have the same sort of run on the bank dynamics that a commercial bank would have. However, in this macro environment of all these macro headwinds of US dollar wrecking ball, slowing growth, etc., it doesn't boggle the imagination that his fundamental business might be slowing down as well, not even counting any sort of perception to reality issues where if you're his long-term client, you look at his website, there's barely anything on his core business. Everything is Bitcoin, laser eyes, like the guy's like gone crazy. Would you think twice about renewing long-term contracts? Maybe I would think about at least a second source. So I view the perception to reality risk as real. And now when he's got coupon bearing debt on $700 million of debt, 200 of which is SOFR based, floating.
Yeah, well, Michael, can you just explain the significance of that? Is that you're not locking in yield. Oh, I sold a bond at 1%. No, you sold a loan at 3%, and as interest rates rise, what you pay rises too. So you are chained to the Fed, essentially. You're not free.
Yeah, that's right. Look, if it weren't for the fact that he made this sort of he painted himself into a rhetorical corner by saying he's going to spend every cent of liquidity on buying more Bitcoin, he would have been in decent shape because he could have managed his balance sheet and maybe deviated from his plan and diverted some of the liquidity to buying back some of the bonds at a discount, or basically delevering that way. But I think he's too far gone now to even do that, because with so little excess free cash flow net of CapEx, and he's got coupon bearing debt, I think he's just got to hope that Bitcoin holds at current prices and his business doesn't deteriorate to the point where he's forced to delever at an inopportune time. What's kind of scary, and if I were him, I would be losing sleep over this. And I don't understand how some people touted this as a good thing, but when Terra blew up, about 80,000 Bitcoins were liquidated, and that caused a 25% drop in the price of Bitcoin. Some people were touting that as some sign of resilience. I see it exactly as the opposite. The sort of inelastic supply cuts both ways. 80,000 Bitcoins represents exactly 0.4% of total coins in existence. So you're telling me that 0.4%, a 0.4% liquidation caused a 25% drop in the price, and that's a good thing. I would be worried about that if that's my primary treasury asset.
Michael, you said that if you were in his shoes, you would be losing sleep at night. I actually, unless I'm misremembering, and if I am misremembering, I'll delete this footage. So if people hearing this, then I'm not misremembering. But I think I heard Michael Saylor say in an interview in 2020 that when he first got into Bitcoin, he lost sleep at night because Bitcoin excited him so much, and he lost sleep at night because he was worried that he wasn't going to buy enough. So I think Michael Saylor might have the exact opposite fear than you, Michael.
The only difference is go back to that chart of the federal balance sheet and let's take a look at where we're at 2020 versus 2022. That's the big difference. I would say that in 2020, look at the federal balance sheet went from 4 trillion to 9.5 trillion, and now we're on the cusp of unwinding that, as opposed to just having basically being in the middle of that pump.
Michael, walk us through what a deleveraging would look like and at what price Bitcoin would have to fall to, how long it would have to stay there.
No, well, he's not in trouble right now. He's officially he's not in trouble right now. Like I feel like I've been misquoted a lot on this, basically because people think that because I point out the potential time bombs in his capital structure, that I've somehow said that he's about to lose his business. I said no such thing. I basically said that, look, he's put himself into a corner where perception to reality risk is real, and his lack of cash flows could be the constraining factor. The other issue that I would point out is that if and when he trips a financial covenant, and again, this was not as much of an issue when he just had 1.7 billion of near zero coupon convertibles, but it's a material risk now that he's got 2.4 billion of debt, 700 of which is coupon bearing, and have financial covenants. So if he trips a covenant, I used to always tell my analysts, look, in a bankruptcy, all maturities spring to tomorrow. It doesn't matter whether you have 2025 maturities or 2050 maturities, because in a bankruptcy, all of those maturities need to be met before there's any value to the equity. And so when you look at his balance sheet now, right, the break-even value, I guess this is the way to think about it, right? The price, the Bitcoin price, the minimum price that Bitcoin has to be at for all of his debt to be made whole at par in a liquidation is around just below 19,000. So if he trips some sort of covenant and he's put into liquidation, right, Bitcoin has to be above 19,000 for the equity to get a dime. You follow?
Yes.
So that's not to say that it's going there or that Bitcoin is going there, but I think one of the names of I think this last thread that I wrote, the penultimate thread that I wrote on MSTR is called the MSTR tail wagging the Bitcoin dog, and the point of that was basically to show how if he does trip a covenant, whether it's due to perception becoming a reality risk or Bitcoin itself going down, causing him to start liquidating Bitcoin, it could be a situation where it's MSTR, a very concentrated whale liquidating into an illiquid market that actually wags the Bitcoin dog. So I think that's an interesting dynamic. So that's my view on MSTR.
Okay, so yeah, help me understand this a little bit. I didn't want to make it seem like you were being more dramatic than you actually were. So as you rightly pointed out, the earliest that MicroStrategy owes on its debt for its debt maturity schedule is 2025. So the financial team at MicroStrategy, if you were going to follow through on this plan to borrow as much money as you can and buy Bitcoin, it was, you could have done a much worse job. Let's put it that way. So it was the earliest that's due is 2025. So what's the problem? I mean, can Bitcoin go to $1,000 and there's no problem, or you say these covenants have to get triggered? What are those sorts of covenants?
So I don't know the actual breakpoints of when he might hit those covenants, but the point I was making is that the maturities, again, back to my comment, in a bankruptcy, right? It doesn't matter what your maturities are, and so that's actually critical. It doesn't matter this Silvergate loan primes everything else, both from a capital structure standpoint and from a temporal standpoint, from a maturity standpoint. The Silvergate one is March 23rd of 25. So that actually jumps even in front of the first convert, which matures 12/15/25. There's also a if memory serves, it's buried in one of my threads. There's I think the senior secureds had some springing maturity on one of the converts, if I'm not mistaken. Or no, it's something to do with like if the 0.75% convert tripped its covenant, then it would cause the June 15th, 28 note to also jump ahead. So he's got a couple of these sort of accelerants. But again, that all still misses the point. My point is that it doesn't matter whether it's a 25 maturity or a 35 maturity or a 50 maturity if he trips a covenant and goes into default.
Okay.
That's the main point. That is the main point, because perception to reality risk is the key here.
Okay. But if the business fundamentals of the software business are amazing, but Bitcoin goes down to $10,000, does that trigger a covenant?
No, not necessarily.
Okay.
No, I think there are some collateralization. There's collateralization requirements for the Silvergate loan, but that in and of itself doesn't pose an issue, right? Because again, he's got time. So it's not as if he's going to get margin called anytime soon. That is totally not the point of any of the threads that I was writing about. What the threads that I'm writing about is that he's basically swapped a 0 vol asset to a 100 vol asset, and you've now layered in these short put dynamics into his capital structure that are subject to real, sort of perception to reality business deterioration issues. So if even the blue chips of the FANGs are experiencing major growth headwinds, I can't imagine he is immune to that, especially if you attach the negative optics of having levered his capital structure with Bitcoin. That's my point.
Got it. The short put optionality, that is a huge problem. Correct me if I'm wrong. Isn't that huge problem borne by people who own the convertible securities and not MicroStrategy itself, and not the equity holders of MicroStrategy? Or am I missing something?
No, you're not missing something at all. I wrote a thread about exactly that, and it's called MSTR More Real Options Thoughts, April 29th of 21. I basically said, yes, technically the answer to your question is yes, but practically speaking, the company is 99.9% incentivized the same way as investors. So even though you could argue that from a narrow zero-sum perspective, the bond issuer wins if bond investors lose and the real put gets exercised, right? But the thing is, what company's CEO issues a bond to win from that perspective? You know what I mean?
Yeah.
So for all intents and purposes, you have to look at it from the investor's perspective.
Mm-hmm. Michael, could we also just disclose your position with regards to MicroStrategy? I think for a very long time you did not have a position at all, but that has recently changed, right?
Yeah. So exactly. So I hate talking about stuff where I actually have an interest in it. And up until last week, I had no position in Bitcoin or in MicroStrategy. As of last week, when MicroStrategy stock ripped because of what I think of as negative gamma short covering, I put on like a put spread in MicroStrategy. So I do have a position in it, but it's not material. I just think that it's interesting. So one of the things about negative gamma is that when you are in the that distressed zone, you will see the stock make massive gyrations, both on the downside and on the upside. And that is because, if you go back to that chart that I keep talking to, right, the steepness of credit deterioration in that distress zone makes it so that if you're a convertible arbitrageur, it's nearly impossible to hedge, because on the downside, your credit losses are going to massively outstrip what your equity can do. You could be on a 300 or 400% delta and still be under hedged. But then when there's a short covering rally caused by whatever, all of a sudden your 400% short is going to be a massive overhedge. So you're just going to see crazy vol in the stock for the foreseeable future until, if the stock recovers back to like 500 or 600, then you're going to see it calm down, because it'll be at least one of the converts will have moved out of the distress zone. But at 244, the both converts are deeply out of the money, and so you're going to see massive vol, and that's why I put it on. So it's just a tactical trade. But I thought, you know what, I've been tweeting about this for so long, and basically, have had like zero skin in the game, and so I finally put a little bit of money where my mouth is on this one. So just for fun.
Yeah, the more I learn about it, Michael, the more I sort of have a certain respect for how the trade was put on. I mean, it does sound like a pretty wild idea to borrow fiat currency, which has very low volatility, to buy a very volatile risk asset such as Bitcoin. But if you're going to do that, as I said, there are worse ways to do it. And I will say, just going through a lot like the recent SPAC issuance, which, you think that they've stopped de-SPACing. Nope. The deals are still going through and they're still priced at $10. I think I see a lot more, there are companies that are a lot more financially vulnerable than MicroStrategy. Of course, there are some vulnerabilities there. But Michael, we are going to have to leave it there. This has been a fascinating conversation. You left me and my audience so much to think about. People should definitely follow your Twitter threads at Urban Cowboy. And Michael, thanks so much.